Hey again, everyone. Thank you for joining us today as we focus on a topic that most people have top of mind when discussing their own goals related to wealth, retirement. Specifically, when can I retire? How much do I have to save and how should I save it? Well, we're going to address those questions today, including methods of figuring out a rough estimate of your retirement number. And we'll learn about the different kinds of retirement savings plans that are available to most people. That will more than fill up our time for this video. But an equally, if not more important question that many of us don't spend nearly enough time thinking about is, what do I want my life to look like after I stop working? After all, a wealthy life is not just about a dollar figure. We'll focus on that in the next lecture, on how we start spending our nest egg. This slide is a reminder of what true wealth is all about. I'll skip over it quickly since you've likely seen it before if you've watched any of my previous videos. If not, I encourage you to go back and watch from the beginning of the lecture series where we talk about it in detail. And here's the outline of mileposts along the journey. After this lecture, the remaining few switch gears from accumulating to distributing. That can be an interesting and more difficult than you think transition, but ultimately is what makes life fulfilling. But first, let's keep our focus on the accumulation phase of wealth creation and be sure that you're successful there. Because if you're not, the distribution phase will be way more stressful. Saving money for retirement should begin as soon as feasible. The more you save early in your career, the healthier your nest egg will be when you're ready to crack it open. Remember the concept of time in the market and the power of compounding interest that we talked about in the investing lecture. Well, this is why it's important, to give you the opportunity to live the life that you want when you're no longer drawing in income from work. So how much do I need to retire? The answer to that question depends on how much you plan on spending in your retirement years and how long you expect to live. We definitely don't want to run out of money in our old age when we're at least able to do anything about it. So it's good to be conservative and build in a safe cushion in case you or your spouse do end up living beyond the average life expectancy. There's about a 20% chance that one partner in a couple will reach their mid-90s. So that is what I plan for. How much will I spend in retirement? Also, that may not be an easy number for you to figure out with certainty unless you're getting close to retirement age. In general, you will likely have fewer expenses in your retirement years. You've hopefully paid off or significantly reduced your mortgage and other debts. You won't be paying disability insurance and most likely won't really need life insurance either. You aren't saving for college education for your kids, although maybe for your grandkids if you have them and you want to give them a hand. Most people pay less for clothing and housing items. You won't be commuting to work. You won't need to be socking away large amounts for retirement anymore. You'll probably pay less in taxes. You may end up paying more for health care, especially before Medicare kicks in. Hopefully you'll get to pay more for lifestyle upgrades, all the things that you've been dreaming about during those long work days over the last several decades, like travel, hobbies, family vacations, etc. So you need to add all those things up together and come up with a number for an estimated annual expense. Chances are that the older you get, that number will decrease as you find that it becomes harder to do some of the things that you enjoyed in your early retirement years. Once you've figured out your estimated annual expense number, there are several ways to anticipate how much you will need in your retirement accounts to fund that lifestyle. A common approach is something called the 4% rule. This states that as long as you don't take out more than 4% of your nest egg on an annual basis, you're very unlikely to run out of money. If you're taking out 4% of your money every year, that means you need 25 times your annual expenses in your retirement account. So if you anticipate needing $100,000 per year to meet your expenses, then you need $2.5 million in your account. If you spend $200,000, you'll need a $5 million nest egg. Now, the 4% rule assumes that you take out the same amount every year, regardless of what the market is doing. But there's nothing that says you have to do it that way. If you can be flexible in your spending, then when the market has a good year, you could take out more than 4%. And if the market has a bad year, you take out less. That's okay. It will most likely leave you with the same chance of success as long as you average around 4% and you don't take out more than that when the markets are down. Another useful tool is called the rule of 72. This is how long you would expect your investments to double at a given rate of return. It can help you figure out what your current nest egg will grow to when you need to start spending it. It works like this. You simply divide 72 by the anticipated rate of return on your investments, and that tells you how many years it will take for your invested assets to double. So if I'm invested in a way that I anticipate an 8% return, I take 72 and divide it by 8, and I get 9. 9 years for that investment to double. If I invest more conservatively and anticipate a 5% return, 72 divided by 5 is 14.4 years to double. What if I earn an average 10% return? 7.2 years. These are simple, easy to do yourself calculations that can give you a good ballpark for your retirement number. If you work with a financial planner, we typically use software that can help you narrow this in based on a variety of other variables. It can give you a statistical spread of outcomes based on how you're invested, your expenses, your lifestyle goals, and potential market factors that could affect your investment returns. So, now that you know how much you need, what are the ways that you can save and invest your money to be able to get to that number as soon as possible? Here's an overview. I'll talk about each of these in more detail on subsequent slides. The vast majority of us use workplace retirement plans as the major method of saving for our retirement. If your work does not offer such a plan, then it is up to you to create your own. If you're self-employed, you have several options that we will talk about. In addition, the government allows everyone to save additional money in what is known as an individual retirement account, or an IRA. We'll talk about some of those rules. Many high-income professionals have money left over to invest after maximizing their retirement accounts, and will use an individual brokerage account to build up their investment nest egg even faster. Finally, over the years of paying off a mortgage, the value tied up in our personal homes can often be quite sizable and can make up a decent chunk of our total net worth. I'm not really going to talk about it in this lecture, but there are ways that you can access that equity if you need it in the future, including a home equity line of credit, a reverse mortgage, or simply selling your house and downsizing. Let's focus now on the alphabet soup of workplace retirement plans. It can get quite confusing to understand fully what you're paying into and how it all works, especially if you change jobs a few times over your career like most of us do. Hopefully this can simplify it for you. Workplace retirement plans come in two basic varieties. One is called a defined contribution plan, and the other is called a defined benefit plan. Think of it this way. Defined contribution plans, or DC plans, are plans that employees contribute to from their salary and have some control over how much they contribute and how it is invested. On the other hand, a defined benefit plan is something that is paid for by the employer, and the employer controls how it is funded and invested. With a defined contribution plan, when you retire or leave the company, you get whatever you contributed, anything the company might have pitched in, and whatever growth may have happened to your investments over the years. So your total payout is in a large part up to you, how much you invest and how you invest it. With a defined benefit plan, the company pays you a guaranteed set amount every month according to a pre-designed formula that is based on your salary and the number of years you work for them. Most people would recognize that as a pension. We'll look a little deeper into defined benefit plans in a few minutes, but first let's look at DC plans, because those are a lot more common today. So most people who have defined contribution plans at work know this as a 401k plan, but there are other versions. Some that are quite similar to a 401k, like a 403b, and some that are more similar to a pension plan. Before we get to those differences, let me explain some of the similarities. First, the money that goes into these accounts are contributed by the employee and generally withheld from your paycheck. For most of them, you get to choose how much you contribute each month to your retirement. To encourage you to contribute and as a benefit to their employees, companies often match a percentage of your contributions. In other words, they will add money to your account up to a certain amount as long as you are contributing. That's like free money. It should always be taken advantage of if at all possible. Second, the money that you contribute to these accounts is tax deferred. This means it is taken out of your paycheck before you pay taxes on it and does not count as taxable income. It grows in your retirement account tax-free until you take it out during retirement. That is when the government taxes it as income, but it's your retirement tax rate when presumably you will be in a lower tax bracket. So this is a really good deal because your money can grow a lot over those years without paying taxes on the growth every year. Some other general rules for DC plans include limits on how much you can put into them every year as an employee. It's currently $23,000. And how much your employer can invest in your plan on your behalf. The grand total yearly allowed investment is currently $69,000. If you put in the maximum of $23,000, then your employer could add up to $46,000 if your salary supports it, can't be more than 25% of your gross salary, and if the plan is set up for that kind of contribution through a profit sharing plan. For employees over age 50, you can contribute an additional $7,500 a year in a 401k. Some DC plans called money purchase plans require the employer and sometimes the employee to contribute a fixed percentage of their income. A 401a plan is an example of a money purchase plan. And some DC plans are set up like pension plans, but without the guarantees. These are called targeted benefit pension plans. Depending on where you work, you may have a combination of these plans as options, or you may work for more than one company. If that's the case, you have to know that your total contribution as the employee between all these accounts combined cannot exceed the maximum additions amount of $23,000. But your employer is not bound by that number. So each employer can contribute a total of $69,000 as long as the other rules are followed. Another common characteristic of DC plan is that to a degree you get to choose how you invest that money. Of course, with that choice, you are assuming the investment risk, the chance that your money could either increase or decrease in value depending on the choices that you make and how the market moves in the future. Your choices are typically restricted, however, to a handful of investment options that they give you, that they deem are reasonable choices. You may or may not agree with them, but you're kind of stuck with what they give you. Most of the time, these are a combination of index funds, mutual funds, and bond funds, or maybe a selection of targeted date funds. Be careful in your choices. Look at the expense ratios or the fees of each of your choices and be sure that what you choose fits into a well-designed investment plan based on your risk profile and time frame. Bottom line, if you have a defined contribution plan at work, be sure that you spend some time with your HR department or carefully reviewing your retirement plan paperwork to be sure that you understand all the rules and nuances of the plan that they offer. For defined benefit plans, there are two basic types: a traditional benefit pension and a cash balance plan. In general, these plans guarantee some sort of benefit using a formula based on your salary and number of years you work for the company. The employer is required to pay it and must contribute enough and invest appropriately so that there are sufficient funds in the account to pay your benefit. They must use an actuary to help them figure it out every year. The only risk to you is if the company goes bankrupt. But thankfully, they are required to participate in a government-backed insurance program to ensure that you still get what you are owed. These plans are risky and expensive for the company, so are typically used only by large and stable companies. You also have to work there long enough to be eligible to participate. A traditional benefit pension typically gives you a monthly benefit for a given amount of time, usually for your life and a percentage to your spouse after you die. A cash balance plan guarantees you a certain cash amount that you can either convert into a monthly payout or you can take the cash in a lump sum. Sometimes these plans are used by small businesses like physician practices who have well-compensated owners that are closer to retirement. They allow you to put a relatively high amount of tax-advantaged money into the owner's pension, with a smaller amount going to their younger employees. There is an additional type of account called a 457B plan. These are offered to government employees and by some nonprofit organizations. These are cool because they act like a second retirement account to the employee. In other words, you're not bound to the total $23,000 contribution in other plans, but can add another $23,000 in the 457B. They also have special catch-up rules, and you can withdraw money from them without a penalty even before the age of 59 and a half. So if you have this option, it's a great way to really stack up your retirement savings. What about if you have your own small business? What options do you have then for a retirement plan? The most common are a SEP IRA, a simple IRA, and a solo 401k. Solo 401ks are only available for you if you have no other employees except for you and your spouse. They work essentially like a regular workplace 401k, but there is some flexibility with how you set it up that gives you some savings advantages and some tax advantages. With a solo 401k, you are both the employee and the employer. So you can contribute the full amount of $69,000, assuming that your salary supports that contribution. You can also set it up to allow Roth contributions, mega backdoor Roth conversions, and to invest in a broad array of things, including real estate, which is not typically allowed in a workplace 401k. A SEP IRA is another small business retirement plan that can be used if you're not eligible for a solo 401k because you have more than you and your spouse as employees. It allows employer contributions only, and the employer is not obligated to contribute every year. All employees must be treated equally in terms of percentage of salary as long as they meet certain requirements of age, salary, and time with the company. Total contribution limit is $69,000 per year. A simple IRA is another option as long as you have 100 employees or fewer. Employees and the employer contribute up to a maximum of $16,000 per year. Employers have specific matching rules. These are intended to be easy to administer with minimal costs and filing requirements. In addition, everyone is allowed to use an individual retirement account or an IRA and contribute to it outside of or in addition to your workplace retirement account. The current maximum annual contribution limit is $7,000 per year. This can be tax deferred as long as your income is $123,000 or less as a married filing jointly couple in 2024. Most physicians out of training make more than that. In that case, you can still contribute, but you don't get the tax break. Many high-income earners utilize this opportunity to build money in a Roth IRA account through a process called a backdoor Roth. A Roth IRA or a Roth 401k means that you pay taxes on that money now. There's no tax deferral, but then you never have to pay taxes on it again, either on its growth or when you cash it out down the road. That could be a great deal if you're in a lower tax bracket now than you expect to be in the future. But there are income restrictions on whether you can utilize a Roth IRA. A backdoor Roth is how you get around that. You essentially contribute to your traditional IRA in after-tax dollars and then immediately transfer it to a Roth IRA where it can grow tax-free. So it's a good way to get Roth IRA money and not pay any more taxes than you would have had to pay anyway into a traditional IRA. Again, there are important rules and penalties to understand before you utilize this method. So consult an accountant or a financial advisor. Finally, many physicians who are good at saving end up maxing out their tax-advantaged retirement options and still have money to invest. You always have the option to save more money by setting up an individual account with a brokerage. Most people use one of the big discount brokers like Fidelity, Vanguard, or Schwab. If you have a brokerage account, you can invest in whatever is offered at those companies, which is typically thousands of mutual funds, bond funds, index funds, and all the individual company stocks that are traded on the stock exchange. So it's wide open. In a taxable account, however, every time you trade or sell an investment, there are tax implications known as capital gains and capital losses. If you make money on that investment, you owe taxes on it. If you lose money, you can count that against your gains and get a tax deduction for up to $3,000 per year in net losses. The amount that you pay in taxes depends on your income and how long you held that investment before you sold it. That's all I'm going to say about taxable brokerage accounts in this lecture. If you're in the situation where you have one of these accounts, you need to do some research or get an advisor who can explain all the details and tax implications. Okay, let's be done for now. That's a lot to remember, and the average person does not need to know it all. If you're an employee, just be sure that you understand your own company plan so that you can maximize your tax advantages and get as much money into your retirement accounts as possible. If you're self-employed or a small business owner, it's probably a good idea for you to speak with a business consultant, an accountant, or a financial advisor to understand what your options are to set up your own retirement account. And if you are maximizing these methods and still have money left over, you can add more using an IRA or maybe a backdoor Roth IRA or ultimately a taxable brokerage account. I hope this has been helpful. remember that the quality of your distribution phase of life all depends on how well you do in the accumulation phase. Next time, we'll talk about how to spend what you've accumulated. You know, the fun part. Thanks for listening. Please hit like and subscribe if you find this content useful, and share it with your friends. I appreciate you. Take care and see you next time.